Hi guys, thanks for joining us. I'm Erin Wicomb with Mavrik Investing, and for the last 10 years I've bought and sold over 200 million worth of real estate, residential, commercial, and I get a question all the time. The question is what you do like a REIT? Or what is a REIT? What does that stand for? What does REIT stand for? And today I'm going to break it down. What exactly is a REIT? You ready? Let's go. First of all, a REIT stands for Real Estate Investment Trust. Essentially, it's an opportunity for investors to buy shares of a commercial real estate portfolio. Most of the time, it's traded on the public stock market. REITs were invented in the 1960s in the United States. It was created in the 1960s, but they mean different things in different countries. In fact, REITs are not the same thing in other parts of the world. In fact, in some parts of the world, it's not even allowed yet. And recently, countries like Mexico just created an opportunity to be able to do that, to do a similar structure. And Australia is one of the second largest markets outside the United States that has REIT opportunities. So basically, REITs allow investors to be part of a bigger portfolio. And often that portfolio includes commercial real estate made up of office buildings, hospitals, which is hospitality, storage units, data centers, retail centers, self-storage, timberlands, warehouse, all those sort of things. But basically, the basic structure of real estate is it's a public company, and most of the time there is about 100 shareholders at a minimum. And the basic structure is that 90% of the income needs to be dispersed to the shareholders. There are three basic types of REITs. There is the equity REITs, which is the most popular. And equity REITs are those portfolio companies or REITs that own the buildings. They own bigger buildings. And most of the time, those are large office buildings or large data centers that are tough for the individual investor to own. And that's why that REIT is structured that way, which is the way to be able to aggregate huge capital together to be able to buy larger transactions. So equity REITs manage and own large properties. There's also what's called mortgage REITs, in other words, debt REITs. So these are an aggregation of capital that lend on a property, that lend on real estate, such as mortgage-backed securities or some sort of private money REIT that basically push loans and debt on properties. The third type of REIT is a hybrid REIT, and those are companies that do both. They do equity ownership and they do mortgages or debt on properties as well. They're less common. Most of the time, REITs are specialized to what they do, and majority of REITs are equity ownership, where they own and manage properties. There's three types of REITs. The first one is public REITs, and what public REITs means, it's traded on the stock market, such as the New York Stock Exchange, the NASDAQ, and these are portfolio of companies that you can easily be able to buy and sell shares from because it's traded on the stock market. The second one is non-traded REITs. These are public, but they're non-traded, which means they're registered by the SEC, but they're not on a stock exchange. And there's different reasons for that, different size of the offering. Maybe they don't need to be traded, or they don't want that level of transparency by being on the stock exchange. That's what a public non-traded REIT is. The third type of REITs are private REITs, and these are mainly smaller REITs that are not traded on the stock exchange. They are smaller, they can do smaller deals, and you have access to them through your financial advisors or through friends and family that know operators or syndicators or sponsors that do these private offerings or private REITs. Sometimes they're called crowdfunding, sometimes they're called syndications, sometimes they're called a fund, but essentially they're all the same thing. Those are private REITs. They're non-traded on the stock exchange. There are different pros and cons of investing in a REIT. I'm going to break down for you the pros first of all. The great thing about investing in a publicly traded REIT is that it's liquid, right? It's shares in the stock exchange. You can get in and out of it every time because there's a big marketplace for you to buy and sell your ownership. You can be involved in different types of REITs that offer different types of diversification. So the second pro is diversification, which means that in some of the REITs that you invest in will have an office component, a residential component, a multifamily component, a retail component, and that gives you the diversification. The third pro of investing in a REIT is that it is on the stock market, so there's a lot of transparency. The books are open to the public. You have to have distributions on a monthly or quarterly basis, and that level of transparency you only get with a public companies. It's harder to get that on a private company. Another thing about investing in a public REIT is that you are required to have audited financials on an annual basis. That really, allows the operators of these to be really institutionalized. And the fourth on investing in a REIT is that you receive dividends. You know, you invest money and you receive money on a consistent basis because of the income that is getting produced has to be distributed to shareholders on a regular basis. Now let me break down the cons or the consequences or the bad stuff about investing in REITs, because it needs to be aligned to your strategy. You need to understand what the downside is as well. The first downside is that there's not a lot of growth. Most of the time, the dividends that gets produced by a REIT has to be distributed to the shareholders. In fact, 90% of that is distributed to the shareholders. So you're not reinvesting in the property is not increasing in value, you're just getting your consistent income. So there's not a lot of growth, just that dividends. The second downside of investing in a real estate investment trust is the taxes. It's taxed at real estate at regular income level, which means it's earned income. So you're often in a high tax bracket from investing in a direct REIT. The consequence is that you also get a lot of market risk by investing in a REIT because you cannot control the market, and oftentimes the interest rate, whatever happens with the interest rate, whatever happens to rental prices, that affects you on both sides as an investor. The fourth consequence or downside of investing in REITs is sometimes these sponsors or operators or companies can have really high fees. They take high fees for putting these REITs together. That can really bring down the income that you're getting throughout the life of the investment. You have to find out and make sure that there's, understand the fees that you're paying for when you're doing these kind of investments. That's a huge downside, because the company has to be incentivized to be able to do deals and create it, and they're not getting a huge portion of the rental income, and they're making a lot of their capital on fees. They're making a lot of their money on fees. The biggest downside, however, that I feel that the REITs provide is that most of the time you're just investing for the income. So there's no growth, right? So you're not able to increase the equity of that asset that you're actually investing in. The only thing you're really investing in is that distribution, that dividend that you're getting. So you're basically purchasing income. And in an ideal world, you want to be able to get income and you want to be able to get growth. And that's it. That's basically your breakdown of what exactly is a REIT, right? If you have any questions or would like to learn more on private syndications versus public syndications, take a look at some of our other videos. Email me directly, leave your comments or questions below. I'd love to get back to you. Make sure you like and subscribe as well for more videos like this. Thanks for watching.